Hello everyone and welcome. I'm Bilal Safdar and I'm excited to be here with you today. Today, we're going to explore the fascinating world of market structure. This presentation is titled Understanding Market Structure, and it will give you a clear overview of how markets are organized and how they function. We'll cover the key concepts, different types of market structures, and why understanding this is crucial for making informed decisions. So let's dive in and get started. Market structure refers to the overall framework of price movements in trading. Understanding this structure is essential because it helps us make more informed decisions. When we recognize how the market is behaving, we can better anticipate future moves. The key components we look at include trends, impulses, corrections, and specific price patterns. These elements work together to guide our analysis and strategy development. By mastering market structure, we gain a clearer picture of where the market is headed and how to position ourselves accordingly. This foundation is critical as we build our trading approach throughout this presentation. Let's talk about the key components that help traders navigate the markets effectively. First, trend analysis is essential because it allows us to see the overall direction the market is moving. Impulse movements are the strong, decisive price actions that indicate momentum, while corrections are the smaller pullbacks or consolidations that happen along the way. Recognizing these elements helps us identify potential entry and exit points more accurately. Understanding market structure ties all of this together. It's about seeing how price interacts within the bigger picture, which is crucial for making informed trading decisions. When we grasp the market structure, we can better anticipate future movements and adapt to different market conditions. This knowledge is fundamental to improving our overall trading performance because it provides clarity and confidence in our decisions. Remember, the goal is to develop a clear picture of the market so we can trade smarter, not just harder. Understanding market price movement in trading is fundamental because it helps us recognize how prices change over time. When we can identify these movements, we gain insight into the overall trend, whether the market is going up, down, or moving sideways. This awareness is crucial for making informed trading decisions. Now, on this slide, we're focusing on the key elements of market structure. These are the building blocks that shape how we interpret price action. First, we look at trends, which are the general directions prices are moving. Recognizing these helps us align our strategies with the market's momentum. Next, we consider impulses and corrections. Impulses are strong moves in one direction, often signaling a continuation of the trend. Corrections, on the other hand, are smaller pullbacks or reversals within that trend, offering potential entry points or warnings. By understanding these elements, trends, impulses, and corrections, we can better anticipate future movements and refine our trading plans. This understanding ties directly into the overall goal of mastering market analysis, enabling us to navigate the markets more confidently and effectively. A trend represents the general direction of price movement in the market over time. It can be upward, downward, or sideways. Recognizing trends helps traders make informed decisions and adapt to market psychology effectively. Understanding trends is essential for successful trading strategies. A downtrend is characterized by lower highs and lower lows, signaling prevailing selling pressure and a potential market reversal. When we see the highs getting lower and the lows also decreasing, it suggests that sellers are in control, pushing prices down. This pattern often indicates that the market may be heading into a bearish phase, but it also signals a possible reversal point if the trend begins to change. Recognizing these signs is crucial for traders to make informed decisions. Understanding whether the market is trending up or down helps us align our strategies with the overall market direction. So, in summary, a downtrend shows us that sellers are dominant, and it's essential to watch for signs of a reversal or continuation in this pattern. Let's take a closer look at some visual examples of an uptrend. An uptrend is essentially marked by a series of higher highs and higher lows. This pattern shows that the price is consistently moving upward over time. It's like climbing a staircase. Each new high is higher than the last, and after each peak, the price dips but still remains above the previous low. Recognizing this pattern is crucial because it helps us understand the overall market direction. When we see an uptrend, it indicates bullish momentum, and that can influence our trading decisions. Connecting this to our broader theme, understanding how to identify these trends allows us to better anticipate potential continuations of the move and make more informed choices in our trading strategies. In trading, impulse refers to a strong price movement in the direction of the trend. It often represents a surge in buyer or seller activity, indicating that the market is really moving decisively. These impulses are key because they show us where the momentum is heading and can signal good opportunities for entering trades. On the other hand, corrections are basically temporary retracements against the main trend. They might look like a pause or a small pullback, but they're actually healthy parts of the trend's development. Corrections give traders a chance to jump in at better prices, essentially offering a window to enter positions more favorably. Understanding these two phases, impulses and corrections, is crucial because it helps us interpret market behavior more accurately. Recognizing when the market is in an impulse phase versus a correction can really improve our timing and decision-making. So, in the context of overall market phases, mastering how to identify and react to impulses and corrections allows us to ride the trend more confidently and manage risks more effectively. Recognizing correction phases is essential for determining optimal entry and exit points, which ultimately enhances the effectiveness of our trading strategies and decision-making processes. When we talk about timing entries, a correction is basically a temporary retracement against the prevailing trend. It's like a brief pause or pullback that gives us a chance to reassess our positions and plan our next moves more effectively. Understanding these corrections within the broader market context is crucial because they signal potential opportunities or caution points. By identifying these correction phases accurately, we can better align our actions with the market's natural ebb and flow, making our trading more strategic and less reactive. Let's take a closer look at impulse and correction in market movements. Understanding these phases is crucial because they help us anticipate future price fluctuations. When we recognize an impulse, we're seeing a strong move in one direction, often signaling the start of a new trend. Corrections, on the other hand, are shorter-term retracements that occur within the trend, offering potential entry points. By analyzing these phases carefully, we can refine our entry and exit strategies, positioning ourselves to capitalize on the overall market trend. This approach ties directly into our broader goal of mastering price dynamics, enabling us to make more informed trading decisions and improving our ability to navigate market fluctuations effectively. Understanding higher highs and higher lows is crucial because these patterns serve as clear indicators of an uptrend. When we see the price making higher peaks and higher troughs, it signals that the upward momentum is continuing. This helps us confirm that the trend is sustainable, giving us confidence to enter or hold onto positions. Recognizing these patterns allows traders to develop effective entry and exit strategies, especially in bullish markets where momentum drives prices higher. Essentially, spotting HH and HL patterns helps us stay aligned with the overall trend, making our trading decisions more informed and strategic.